With the help of stronger dip buyers, we're trading right back at all-time highs. And yes, of course the concern here is the NVIDIA concentration risk. NVIDIA was up loosely 3.5% on top of the gap up this morning, completely overtaking Apple in terms of market cap. But I do have a chart up my sleeve that'll keep us somewhat level-headed when it comes to actually evaluating these concentration risks. My name's Matt, welcome to the Trade Brigade Midweek Market Update. This is a late night episode. I want to show you that chart in particular, and many more as we finish up this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, and stay tuned until the end of today's show. I've got 5 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the daily time frame chart here for the S&P 500, and let's keep it really simple because ultimately, trading at all-time highs, no need to overcomplicate things. Massive daily high or low, as well as a brand new higher high in the overall trend count. So in its simplest form, the trend, of course, is up. We're sitting on a higher high, and there is no indication of a pullback looking imminent. However, if something were to emerge, we know that we can afford a daily higher low without jeopardizing the uptrend that we're in. If we think about candle structure on today's session, we opened on a gap up, we closed the gap below us, repairing the thin structure. We found support over the 2-day highs. This was also an inside bar breakout from Tuesday into today's Wednesday session, right? So we support over that, which is also the bottom of the original balance range from over here. And then where do we close? Directly at the highs of today's session, well above the bearish engulfer high as well. So structure is incredibly bullish. The trend is up, the structure is bullish. There's nothing about this chart that says at all stronger sellers are coming out to play. So on the daily time frame, if a deeper pullback were to emerge, I would be certainly on board with higher low opportunities anywhere up and over 528.40. I mean, on the hourly chart, we'll see a number of different locations for possible higher lows, but on the daily, that would be my main watch. And the reasoning behind that is if we can stay above, it validates the breakout of the inside bar trade, right? If we get underneath 528.40, if there is a deeper pullback below, it starts to jeopardize anybody who bought the gap fill reversal, anybody who bought the gap up here. This turns into overhead supply, and just structurally, we would be underneath the bottom of the prior balance range from back over here. Not thrilled with activity underneath 528.40, but I wouldn't throw in the towel. I wouldn't be bearish down there. I would be more so neutral than anything else. Let's take a look at the hourly time frame chart where we can start to get a little bit more nuanced here and understand the types of participants in the market. So as we come into this week, if you're a stronger seller, let's think about this. Let's put ourselves in their shoes. You see Monday's morning gap up, right? Monday morning's gap up, and we get this pullback to not only close the gap, but we work our way into the spike from Friday afternoon. Then notice this is technically the base of the spike at 525. There's an initial indication of some small price acceptance underneath the base of the spike. So if you're a stronger seller and you're looking for this downtrend to continue, right, and if you're looking for this to act as a major lower high, then what you want to see is acceptance underneath the engulfer low, underneath the Thursday lower high from last week. You want to see bear flag consolidation here, and then some sort of loss of 522.75, lower high below, and all of a sudden we have equal lows. Oh goodness, we have the threat of a reversal on the daily, right? Did that happen? Again, if we just think about what's actually happened, obviously the answer is no. So we did not have any momentum from the sellers who were able to initially, right, what looked to be a pretty decent size move to the downside underneath the low of the engulfer. Like, I've got to give some credit where credit is due. Like, that to me was a little uncomfortable on the move to the downside. However, as soon as we get back above that for the close, as soon as Tuesday's higher low is above 525, is it fair to say that the sellers had any sort of overwhelming edge in this market? The answer is no. And then simply put, if we're counting trend, now we have lows, higher lows, highs, higher highs, equal high breakout, and obviously right now we're sitting on a massive higher high. So there's total, continuity of time frames right now between the hourly trend being up, daily trend being up, weekly trend, of course, is up, monthly trend is up. It's bullish on all time frames, right? So how do we trade this going forward from here? Because that's ultimately what we care about. Obviously, any consolidation over the engulfer high, that's over 533, incredibly bullish. This itself could be deemed as some sort of bull flag, looking for follow through in the upward direction. If we open on a gap up and it's a gap and go, you guys know the rules. It's the first higher low pullback over an upward sloping VWAP is a potential way to manage your risk. You don't want to be the suckers long chasing the highest high in the overall move. You need some place to put some sort of stop loss. So that takes care of us into blue sky territories over 533. The weekly measured move targets are not in force yet. Remember, that's 570 and 610. Not really thinking about that into Thursday and Friday. If the market does pull back a little bit and we're actually underneath 533, I wouldn't even be thinking about shorts. I would just be thinking about, okay, where's the double bottom? Where's the inverted head and shoulders? Where's the simple hourly hammer candle that supports over 531.40? I mean, very simply put, that's staying over the top of the prior major balance range from over here. That's a very clear opportunity for an hourly higher low. Where things get a little bit more interesting could be on a possible breakdown underneath 531.40. If we do something that looks like this, you'll notice we have a dimmed out level here at the midpoint of the balance range. It's clearly a previous area of resistance that can potentially act as support, but I'd take a nuanced approach at 530. And my take here is that if this turns into a double bottom, I would want to participate on this higher low back over 531.40 on something like a 5 or even a 15-minute time frame chart. If you can spot that setup, great. This is still an hourly higher low. Good to go. If you don't get a double bottom, if you don't get an inverted head and shoulders, hammer candle, the whole 9 yards, everything that we typically talk about, if you don't get that at 530, then what I would instead be thinking about is what's the risk for a lower high here, and can the shorts actually pull off some sort of quick scalp in the downward direction to get us into that daily line in the sand at 528.40? That to me is at least worth entertaining as a possible short scalp. Now again, we're not overstaying our welcome on that trade, and when and if we approach 528.40, we flip the script directly on its head. So this is sure a little scalp, but when we get down here, I'm all aboard the double bottom, I'm all aboard the 5-15 minute, even hourly inverted head and shoulders, hourly hammer candle in here. That really is the primary watch for your daily higher low, retesting the breakout point, right? You want to validate these buyers by ensuring we stay over 528.40. Now, clearly, as we said on the daily, we would become more neutral underneath here because now this appears as a failed breakout. You're underneath this point here. This is continuing to act as potential overhead supply. And the larger downside move, as I'm sure we can all consider at this point, would be when and if you get underneath 525, right? The engulfer bar's low is now going to change the tone of the higher time frame when coming from this highest high. All right. So why is 528.40 such an important level? Hopefully you can understand why based on structure so far, but we're also getting beautiful confluence. Here are the Fibonacci's. I mean, spot on, right on. I couldn't have asked for better confluence out of that level. I mean, there it is, right? We can clear that up and let's take a look quickly at the intraday anchored VWAPs, right? These are slowly, notice the bid-ask spread here in the post market. And again, it's a late night episode. It's 9:30 right now Eastern time. We're trading 535.03 by 04, so very tight bid-ask spread in the post, but that's implying some sort of gap up. What does that mean for the anchored VWAPs, right? They're obviously going to drift higher if we open on a gap up, right? As soon as that volume starts transacting, these will have the tendency to move in the upward direction, slowly offering confluence with, once again, 528.40. So I think it's pretty clear where my head's at for the S&P 500 as we move into tomorrow's session, or really just the remainder of this week. We're really leaning on longs and only carefully being a selective scalp short if this trade opportunity presents itself in the first place from point A to point B, and then promptly changing tone when and if we can find buyers here on the pullback to 528.40. Let's take a look at some more supporting evidence. What do we have out of the market internals? If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's firstly evaluate the pullbacks from the Monday and then even the very minor breakdown from the opening range on Tuesday's session. Did we have any stronger volume outflows to validate the breakdown on Monday? No. Same thing on Tuesday here. It does not get substantial. We're not at negative 300 million. If we look at the advanced decline line, we open in positive territory, close negative, but not even close to trend lower zone. Same thing here on the Tuesday session as that opening range pullback is taking place. It's just not really detrimental. The biggest tell is the cumulative tick here in the lower left-hand quadrant, right? Any exchange level selling taking place on that pullback from Monday's session? Absolutely not. So sellers just totally don't have it going on, and the buyers really have much more of the edge based on purely trade location, trend, as well as structure. We can see that the buyers start to become validated on today's Wednesday session on this gap fill reversal. There's no bearish imprint out of the cumulative tick as the gap is closing. Now, I want to concede as well, like this is not rainbows and butterflies. We all know that NVIDIA is the top dog pulling the market around right now. It's not like we had a cumulative tick that was somewhere around 5,000 positive on this trend day higher. It's just not the case. We did not get to substantial volume inflows on today's session. The advanced decline line was not in trend higher zone for at any point of the day's session, right? Now, I would say that the index score was printing nice and positive here. Some sporadic negative reads on Monday and Tuesday, but you can see that they sort of get a little bit more mild into the afternoon sessions here, whereas on today's session, straight strength directly into the close. There's nothing about that was like, okay, here comes a hint of weakness for an end of day liquidation break. Just absolutely not the case. If we take a look at the market profile to finish up our ES and the S&P 500 look, what do we notice? I know this is pretty zoomed out. However, let's firstly track value area and point of control. Here's Monday, here's Tuesday, and here's today's session. Right, you can clearly see how value area has broken out of the 2-day balance range from back here. And even if we consider where people are primarily holding positions from, these longs are feeling quite comfortable with this breakout from today's session. The reason I'm leaving this so zoomed out is so I can also point out to you that the point of control from today's session is directly to the high of the bearish engulfing bar from, 3 weeks ago now at this point? If we were going to get a stronger like double top rejection, oh my goodness, the market's going to crash, it's going to zero, there's a big daily reversal, I would not think that the most contracts would trade near the high of day at the engulfer bars open. Like if those sellers were going to do it again, this would not have been where the point of control shifted. You would have seen a pullback into the close, and point of control probably would have been more central in the overall profile. It simply wasn't the case, and once again, this does strike me as a slightly more bullish than bearish data point. If you're not familiar with market profile, check out the video tutorial in the top right-hand corner. The NASDAQ is up next, and it's obviously going to be very similar to the S&P 500. Massive daily higher low, higher high as well, new all-time high, strong close from the buyers at the top of the range. The biggest difference is the partial gap close. If you put yourself in the shoes of a seller here, we had thin structure below us, the gap, right? And we were unable to tag up to the previous 2-day highs. That's a failure from the sellers and a success from the buyers. So the daily chart of the NASDAQ does strike me as being slightly more bullish than the S&P for that particular reason. In terms of major structural levels to pay attention to, this flat top area of resistance here is really interesting at 459.25. Any higher low pullbacks there are really like picture perfect rainbows and butterflies. If we go for a gap fill reversal, that's also bullish on the daily time frame. And the major line in the sand, I would argue, is down here at 453. Previous shelf of support a bunch of times in there, finally resolved in the upward direction. Probably don't want to get down underneath that unless you're thinking about, hey, I want this to turn into overhead supply. I want an equal low on the daily time frame chart down here at 442. So 453, major line in the sand if you're trying to remain bullish. The trend count would be lows, higher lows, and some sort of higher low around that zone, something that might perhaps look like that into the future. But again, is there any indication of a pullback? Absolutely not, with the very strong close on the daily bar. Let's move on down to the hourly time frame chart. A lot of the same conversation points to be had over here. You can see the partial gap close. You can see the move in the upward direction. No red hourly bars whatsoever out of the NASDAQ. You can see the flat shelf of previous rejections now having the opportunity to potentially act as support for 459.25 once again. I'd be really interested in this as a possible trade outcome. Again, you could substitute the double bottom with a head and shoulders inverted or a hammer down here. All of those things go. If there is a move underneath that level, I would probably trade the scalp for this. That's a possible idea, moving from point A to point B, and we do not want to overstay our welcome for all the same reasons we described in the S&P. Perhaps the risk reward looks something like this, but I would not overstay my welcome at the 3 equal highs. 1, 2, and 3, you probably don't want to be a new money short directly into a potential new area of support. That level, the gap close, is at 455.50. And of course, again, this could be your idea to get there, but when we get there, it's the double bottom, it's the inverted head and shoulders. Do I sound like a broken record yet? It's all of those same indications, 455.50. If the market pulls back deeper than that, again, you could probably stick around for a short, If you start seeing that the gap is not resolving in the upward direction, if you break this as a bear flag, there might be a short to get into that daily line in the sand. I'm not saying that these things are impossible, but we can clearly see that this market has been rewarding the dip buyers, not so much the sellers looking to short at the lows of an overall move. So if we were to get down here, that's not the ideal location for a new money short to unfold. I think we're pretty clear about our structure, levels, and sentiment overall. Let's quickly check in on the anchored view apps. Slowly over time, the same concept as the S&P. In the post market, we're higher, 464.30 by 32. So as the market opens, potentially on a gap up with lots of volume going through, these will drift higher, making the gap fill reversal an even more attractive trade off of 455.50. If we take those off, and let's go ahead and throw on instead the moving averages is fine, but we did want to take a look through the lens of a Fibonacci low to high, and what you'll notice is boom, pretty picture perfect, 38.2, also supportive of that gap fill reversal, 455.50 as a major area of potential support. If we look at the NASDAQ internals, there's really nothing, overwhelming about this compared to what we were just describing over in the ES. I might argue that the bearish builds out of the cumulative tick were a little bit more meaningful on the Monday and Tuesday session, but structure and location rule all. I mean, would you want to be short just based on that indication? Likely not, especially at this point in time. So almost a mirror image of the S&Ps. I would also argue that the volume inflows today were a little bit more substantial, right? We're much closer to that 400 million than the S&P was towards its 300 million net positive in the upward direction. No major interesting nuances out of the market profile, but we'll look at it anyways, right? Here is the 2-day balance range inside bar on Tuesday, broken out in the upward direction. Value area and point of control are higher. Notice that the point of control is not necessarily slammed up against the high of today's session like it is over in the S&P 500. However, it's still definitely progress in the upward direction here. One thing we can think about is the string of single prints here, sort of scattered through DC and even a little bit of B period as well. If we're in the upper distribution, so meaning if we can stay over the point of control in the NQ futures, that's loosely around 18,970. If we're over that in the upper distribution, bulls on parade, looking for moves in the upward direction. If we're underneath, we could start to be thinking about a little bit more so of that gap fill down towards, on the cash market at least, as we were just seeing, something like 455.50. Let's move on over to the IWM and see what's going on out of small caps, what the differences are over there. If this would load up, here we have it. So on the daily time frame chart, we clearly don't have a trend. I mean, in this box, we have equal highs, lower highs, higher highs, maybe equal back to the original one, lows, lower lows, equal lows, equal lows. Really a balance range, a really choppy balance range at that on the small caps chart. So I don't think that there's an overwhelming edge here, especially noting that we've closed directly in the midpoint. Now, what I will say is on today's session, I do like the recovery over this 203.25 level. Notice that we had previous resistance, support once, 2 times, 3 times directly in a row. All of those lows were very, very nuanced and precise. The fact that we didn't stay below that for bear flag consolidation, threatening the close of this gap below and testing the weekly level, I'd maintain a little bit more of an optimistic stance perhaps into the end of this week. And primarily, if we drop it on down to the hourly time frame chart, what you would be looking for here is if the market pulls back, again, a little bit more acceptable here in the midpoint of a range, anything kind of goes. If we can find a higher low over 203.25, that would be constructive for the S&P 500. So watching that very closely out of the IWM small caps. Of course, on the daily chart, it's also worth just conceding that obviously, this could perhaps just be lower highs. You could be in a daily downtrend here with lows, lower lows, lower lows, highs, lower highs, right? You could technically find a lower high up against 206. So we're not out of the woods here with small caps potentially continuing to pose a threat and again, act as a headwind for that S&P 500. Let's quickly take a look at the market internals for the Russell side of things. Nothing major here. I would say that these basically negate each other on Tuesday's drawdown versus today's inflows. This again negates each other back to back. A little bit more solid of a cumulative build though on the sell side of the the small caps, Russell. You can tell it's late. A little bit more of a substantial move here. And I think that this is a good reminder to also think about what Monday's implication were. I sort of glanced over that on the daily time frame chart, but if we go back over here, on Monday, we had opened over a key inflection point on this major gap up, right? So the fact that we did not get a gap fill reversal, the fact that the sellers were successful in terms of moving back down towards these lows, I do have some concerns out of small caps. And if there ever was a threat for the S&P 500, if there was ever something to say like, hey, slow your horses there in the S&P near those all-time highs, it would definitely be small caps saying, hey, look out. Like, there's not as much relative strength as you might believe. In terms of the market profile out of the Russell, any interesting nuances here? I do think so, right? It's going to be your value area and point of control moving over those 3 equal lows inflection point, right? So the fact that this value area is higher, again, sort of gives me a little bit more of a, the desire to be optimistic into the end of this week, but we'll see. Can we get that rotation for higher? And the main watch over on the cash market would just be the move into 206. Do we spot a lower high there? If so, there's a harsh rejection. Okay, you're just dealing with the daily downtrend at that point, and it's got to be an issue for the S&P 500. Doesn't mean short the S&P 500, but it probably means dial back some of the long expectations. Let's quickly bring back up the S&P 500. We'll glance through the S&P sectors really briefly. One of the issues we had in the weekend update was sector posture. That's been corrected, with the SMH performing the best on the week, up 3.8%. No surprises, with NVIDIA obviously an absolute monster in the upward direction. It is followed, though, by the TLT, and we'll get to that when we talk about risk appetite in just a moment. XLK is up here. That's heavyweight and risk on. XLC is medium weight, but definitely risk on. XLV is heavyweight, but risk off. I think the posture's looking pretty solid. If we look at the bottom end of the barrel, it's the XLE. Energies are really lightweight. Utilities are lightweight and D for defensive. You're seeing this correction as we've broken to new all-time highs, which is supportive of more of a risk-on indication. Let's look at the structural charts very briefly and, sort of glance through them. Is this bullish or bearish? Bullish, obviously. New highs, gap fill reversals, a higher low from here to here. Nothing bearish to say about semiconductors. Next up, the tech sector. We were able to get back up and over this 212. This recapture strikes me as being really substantial. The fact that the sellers were unable to produce a lower high here up against 212.50 and rotate back down to the bottom is a major saving grace for the S&P as a whole. So I like what we're seeing out of the tech sector as well as semiconductors so far. The XLC communication sector, did we not talk about on Saturday the initial stages of a breakout, the lack of the bearish engulfer to even come close to testing that low? This is great. I mean, strong follow through in the upward direction. This is a bullish indication. XLV, one of the threats we described in the weekend update was the possible lower high being set here at 144.75. We're over it. This is the third heaviest weight sector by market cap. We don't want it falling off of a cliff. We don't want it outperforming. It's not like it's producing new all-time highs. I would say this is pretty comfortable and healthy for your XLV. Next up, XLP, consumer staples. Lighter weight, risk off. I mean, it's recovering off of sort of this higher low pullback, absolutely, but it's not breaking out. It's not causing the market to make a new all-time high. It's looking pretty good. XLY is a heavier weight risk on indication. This is where we have some small concerns. Is there the opportunity for a lower high up against the bottom end of the overhead range? Absolutely. 177.75 is still a meaningful threat. If this rolls over here, I would tend to think that that probably helps the case for a pullback in the S&P 500. Let's take a look at real estate, lightweight, not really doing anything here. Energy, the breakdown really continues. There's probably an oversold rally that's ready out of energy. Notice the back-to-back hammer candles, higher low on the bar-to-bar count, trying to find acceptance over this prior gap. I would be thinking about the opportunity for a retracement into here, into the end of the week. If you're looking for an energy trade, you could look at your heavy-hitting names, something like CVX, XOM, of course. Something into 92 is pretty interesting out of the sector, though. So that's a possible idea, but it's not, that's obviously going to be bullish pressure for the market. Utilities, really just balancing up here. We know that this has been an incredible run in the upward direction. No concerns out of this. It's also not breaking out, causing the market to go to all-time highs. Remember, when we're talking about posture risk in the market, we become less trusting of the S&P making a new all-time high if it's being led explicitly by something defensive. Utilities did not do that at all this week. We can see where the clear outperformance is. Materials, nothing changed over here, sort of drifting a little bit lower towards the lower third of the balance range, no big concerns. Industrials, maybe approaching the bottom end of the overall range. So, small concerns down here, but nothing to the point where I would say, okay, time to rock and roll for a big short. And then financials, we've got to have a little bit of a discussion here, right? This is one of the ones worth focusing on. The lack of strength or just really clear direction around 41.20. The fact that this is just consolidating and doing the tango sideways at a flattened out 50 SMA, the double bottom neckline is not really holding up for a key reaction back in the upward direction. I would be slightly concerned here. So seeing the XLF not really participating in any of the move in the upward direction that the S&P is seeing, it leaves the sort of, again, feeling of concentration risk, especially in your mega cap tech and NVIDIA. If those names start to slip, the lack of performance in the XLF, the lack of performance here in the XLY, I think start to paint the picture and say, okay, don't be surprised if we get a pullback in the S&P 500. It would not be a shocker to see the market pull back from that all-time high, even though I understand, I'll go back on my words here, Did we not just say based on structure, there's no indication of a pullback, right? But it's just based on posture that we might be open-minded to that unfolding and be prepared for it. Like, we shouldn't be shocked if that takes place, right? So that's why a holistic view always makes sense. Let's look at some ratio grids here and see what's going on. Relative strength and weakness. So if you're not familiar with the screen, top right-hand corner shows you how to set it up. I love the rebound over the 50 SMA and the XLK. Don't love the breakdown in the XLF, and that's basically a mirror image of what we were just describing over on the structural charts. I do like the rolling over in the XLU. That's a pretty solid look down here. And even the XLP continuing to drift in the downward direction. This is still underneath the 50 SMA as well. Out of healthcare, which as we know is technically D for defensive. If we look at some specialized ratios, this of course is bullish. Let's just quickly fly through them. This is helpful. Would like to see an equal high breakout out of the XLK, XLU. Utilities continue to cool off. Technology continues to move towards those highs. I think you're looking at least a back test here, and that's going to be helpful for your S&P maintaining more of the risk-on stance. If we look at apples to apples, no love. It's been that way for a while, but still just equal lows. We've not broken down. I would be more concerned this would emerge as a red flag if we made a new lower low. Let's move along to the final SMH XLV, bullish based on the outperformance here. What about the Dixie? What's the dollar doing? It's drifting in the downward direction. This is a risk on indication, so we're all good over there. And we've got a huge conversation point here out of interest rates, right? Look at this. Massive inflection point. Have we not been discussing this 4.33 for a number of weeks now? Remember that this breakout, I should really extend that off to the left, is what yielded the sharper pullback over here. The fact that we're not really, I totally just realized we're on a weekly, right? My apologies. This breakout yielded this long downtrend that we were dealing with from the end of the summer of last year, almost a year ago now, into late fall, right? So that breakout is sort of like we're back down underneath where that acceleration took place from. We know that this is a very historically significant level. So underneath 4.33 has to be a tailwind for stocks. What do we know is going on with rates right now? Let's take a look at the inverted ZT. This thing's falling off of a cliff. Can anybody tell me why? I know why. First of all, if you look at what happened in Canada, they've already cut rates. If you look at what's going to happen tomorrow out of the ECB, that's the European Central Bank, right? They're getting prepared to cut rates as well. Madame Lagarde is going to press the button tomorrow morning. If we look at the Fed tracker tool, let me bring this up over here. You can see that the Fed, though, is not really budging. The one thing I will point out is that the odds have increased for a cut here in the September timeframe. What was about 48% odds on Saturday is now sitting at 58% odds. And like, what's the biggest deal that we have to look forward to? It's not really tomorrow. Tomorrow is going to be your pretty standard jobless claims, but it's really the full labor report on Friday session at 8:30. So we'll have coffee and donuts up at the Penthouse Suites as always. However, like this is going to be the big tell. I wouldn't be surprised to see unemployment tick slightly higher to about 4%. We've been seeing really mixed indications. So this morning we got the ADP non-farm, right? And we had this brief conversation this morning about how this technically tracks people who have Social Security numbers, whereas this down below, this does not track Social Security numbers. This is just a survey sent out to business owners saying, how many employees do you have? They don't have to provide proof or anything XYZ, doesn't matter. But generally speaking, that there's going to be something that happens here, because if we take a look, I don't know if it's going to be on the headlines anymore. But of course, we know that there are things going on with immigration and policy. So I'm interested in seeing how the market reacts to the labor report on Friday in comparison of the non-farm government read versus the ADP Social Security read here, which came in incredibly light, 152,000 versus the forecast at 173. So a lot of fundamental data this week, of course, with Canada cutting rates, the ECB ready to cut rates, labor report here. You'll also notice that this is the kicker. This is what really puts Jerome Powell between a rock and a hard place. And it's my view that if he cuts rates simply because other economies are cutting rates, that would be a massive policy misstep. You can mark my words. I'll feel free to die on that hill. But look at what happened here with services PMIs. Now, we don't want these things contracting to the point of like, oh my goodness, why is nobody purchasing services, right? But look at these numbers. I mean, certainly not what we want to see in terms of inflation on the sticky side. So Jerome Powell is totally caught between a rock and a hard place with inflation totally stagnating based on PCE that we got last Friday. It's my view that we're sort of stabilizing at high 2s, low 3s. this is not helpful in terms of coming in hot on the services PMI side of things. I think the only reason Jerome Powell would cut rates aggressively is if the unemployment rate starts approaching something like 4.25 perhaps. If we're in this range, 4.25 to 4.5%, he might be like, okay, we got to start to act and maybe cut rates. But, what is this? Is this meaningful into the end of this week? I think that the reaction will be what the reaction will be out of 8:30 on Friday. We'll trade whatever the reaction is, but that's sort of your context for what we have into the remainder of this week. Let's quickly look at the earnings calendar, the big deal after the close today. You guys were totally bagging on me on Saturday for mispronouncing this. Lululemon, I believe I said melon there accidentally. Thursday, tomorrow morning before the open, NIO could be a sympathy mover for Tesla. I'm keeping an eye on that, but let's move on over back to the charts and see what's going on from a risk appetite perspective. We'll finish this up. We'll try to be brief here. A couple of other divergences, and again, I still have to show you that one chart that keeps us managing expectations from a concentration risk perspective. So big breakdowns here are risk on in terms of duration. That is healthy for bulls in the S&P. If we look at credit spreads drifting lower and sort of stagnating here, this is still healthy for the S&P. No issues out of that. HYG is divergent. So once again, is it unreasonable for a pullback? I think the answer is no. You have highs, lower highs, higher highs out of your S&P 500. I think the pullback might be okay. I think the pullback to test these prior areas, let this potentially play catch up, that would be well received out of the high yield junk here. Let's take a look at Bitcoin. It's just sideways in the top of the range. All good. Looking like a handle, looking like it's trying to break out there. Let's move along to new highs versus lows on a daily chart. So we got to be transparent. We got to cover everything at its face value. As the market broke out to major new all-time highs, did we see a substantial uptick out of new highs versus lows? The answer, unfortunately, is no, and we're still pretty close to the zero line. Now, we're not negative, so that does strike me as like an okay indication, but not nearly as strong as it should be here. Let's go SPX A50R, still underneath the 50% mark. So again, small, I would call this like a yellow flag. It's not a red flag, it's not a green flag, it's just yellow here, quite literally, in the midpoint of its potential read. Now, here we go. In the intro, I said I had a chart up my sleeve that potentially helps us understand concentration risk. And what I want to do is I want to point out, if we do something that looks like this, we can see the market made a high, RSP made a high. If we do something that does this, let's go across and let's find when we broke out to a higher high. It's right here. It's right around in here. So this then represents, if we do that, I know we're just like sort of drawing with crayons now, that's the famous saying. Look at how the market continues in the upward direction. This is sort of like AI mania off of these lows, right? The RSP did not play catch up until a little while later. So the fact that we're divergent here with some sort of lower high does not strike me as being the end of the world. I would be much more concerned about the RSP if it was breaking down to a massive lower low as the market was breaking to a higher high. If it's just stagnating in the range, I think it's very similar to what happened here, right? Where you're not getting a lot of participation, but in the weighted index below, you're getting that move higher. It doesn't necessarily always mean that the market needs to be lower. It doesn't mean that you should go out there and you should short the S&P 500, right? We have this concept of rotation in the market, and don't get me wrong. Like, I'm not trying to sugarcoat the fact that if NVIDIA falls, the market's probably also going to fall. That's very likely going to be the case. But if we see some sort of rotation, and we have been seeing that to some degree with utilities outperforming, but you want to see some better names like the XLC performing well, you want to see something like your XLY starting to perform in the upward direction. If you can get rotation into those names as the XLK pulls back, that will allow your RSP to catch up to an equal high in here, and then possibly, again, things resolve themselves in the upward direction. So that's just a consideration. It's something to have in your back pocket. And again, the illustration is really coming from right here when we make a new all-time high out of, let me do it like this, right? So you can see there is your all-time high right here out of the S&P 500 weighted. Down below, there's the all-time high as we pop up and over. And notice that we are still divergent. It takes a little while before the RSP gets there. And even when it does, it goes sideways, as we were just mentioning, even as the market grinds on in the upward direction. So there's your back pocket idea out of the RSP. It's not like all hope is lost just because NVIDIA is the one stock to rule them all does not mean that the market is going to completely crash and go to zero if it pulls back. Okay, I will say we're closer to the lows. Like, let's not get it twisted. In this case, there's a much cleaner balance as compared to over here. We're closer to the lows, so the threat is there, but only when we start producing lower lows would I be more concerned about the S&P experiencing a much more severe drawdown, right? So anyways, that's that. A little bit long-winded there. VIX, no issues, pulling back aggressively. This is bullish, of course. If we look at the VVIX, also bullish, floored down at 75. However, keep in mind the complacency effect. If we take a look at the one-day VIX, this is underneath the 1275. This, of course, is bullish activity. Anything above, we get slightly more cautious. Uptrend here signifies that we are in contango, which again is bullish. Being below the zero line is also bullish here out of the underneath. We are actually, sorry, this is backwardation technically out of the 9 versus 30-day VIX, which, you know, in the grand scheme of things, I would lean on this one up here anyhow, and the one-day VIX as well. So small anomaly with the blip underneath. For the most part, you can see that we've been spending time more so in an overall contango there. Let's jump through the core list of companies on a speed round. I know it's a late night episode, and I know we're sort of long-winded on that RSP chart as well. Here's Apple on an hourly time frame. Anything that's bullish consolidation over 194.85, aligning with longs. If we do pull back, I'd still keep an open mind to possible higher lows here, looking for support over the top of the long-standing balance at 192.75. So still preferencing longs out of Apple here. We're not yet at the all-time high. It's up there slightly at 199.62. Looking for that follow-through as long as we're outside of this as a daily breakout, right? A daily higher low could form here. We're still bullish out of Apple. Things would change when and if there's a lower high under 192.75. Microsoft, big recovery on today's session. You've got to give credit where credit is due. I thought 419.25 may have acted as a little bit more of a strong hang-up, but not the case. I love the close back above because of what it implies. This is no longer acting as overhead supply. The risk of a lower high underneath has been diminished. We've recaptured the 50 SMA. If we take a look at the hourly time frame here, the look going forward is pretty straightforward. Any higher lows above, close the gap above from the gap down here. So higher lows want to be above now 419.25. Closure is at 426. If it continues to drift in the upward direction, I would not be chasing this thing long up against 426. If anything, there might be a counter trend short that emerges there for the pullback to ultimately unfold, rejecting this as overhead supply. So please be mindful of that. This is not ideal long location. Pullback is a long location here for this, or consolidation is fine. Some sort of recapture inside of this range with a higher low so we can at least manage risk is possibly the next long if it drifts like a balloon in the upward direction. Google is up next. Inverted head and shoulders is in force. I did like the gap fill reversal on today's session. Preference now is looking for entries over 175. If it's below 175, I think you got to let it test one more time, 173.25, looking for the higher low support here. Again, your inverted head and shoulders neckline, possibly looking for that support. But the better longs, I think, is just acceptance now at these highs. And as we know, here's the daily chart, right? This is basically all-time highs. All-time highs out of Google. So the more time you spend over 175, the more I think it's likely that you're looking for blue skies. Let's move along to Amazon. What's going on with Nancy? The double top is still very much so in force. That is not, that ship has not sailed completely yet. It's got to be a breakdown underneath the lows. We're not there yet, but here it is on the hourly chart. Now, I've got to give credit where credit is due, just like sort of Microsoft. I was thinking that there was going to be a stronger opportunity for a lower high underneath 180.25. I mean, initial pullback, yes, but not much more than that. So the close on the daily bar over 180.25 does strike me as being substantial. I don't know that it's a trade just like blindly floating around in here. I would tend to think that the next continuation of this move is either one of these, recapture of the daily 50 SMA that's mixed in there as the blue moving average, right? Or any sort of consolidation that builds out a range is just simply that. It's a range trade. You've got this, and you've got this possibly back in the downward direction. So I'd be cautious of Amazon, noting that the daily trend is not so clear. You've got this double top thing still in force, all of these equal lows. It's in the midpoint of the daily range. You know what we say in the middle, don't diddle in the middle. NVIDIA, the one stock to rule them all. Here we go. We've got to break it down. What do we see? Obviously, new all-time highs, really strong gap and go this morning. I mean, there's not much to say about this other than options traders are likely trying to get their last hurrah before the 10-to-1 split. That's Friday after the close. So with that understanding, I mean, the chart's been very bullish this week. On Monday, consolidation in the upper half, of this balance range. Tuesday was a beautiful gap fill reversal, higher low over that 1144. Now we're just seeing continuation in the upward direction. I would not be a chaser up here, and instead I would be thinking about, okay, tomorrow, do we get a pullback? And if so, does it hold up? You probably have a level in here. There's no technical red bar there on the hourly, but somewhere around 1200 flat. It's crazy that we're talking about these numbers, but 1200 flat is a possible inflection point. If we pull back in support over that, the end of day leg is being validated, so there's a possible long there with a target back up towards the high. Make sure you have a place to put your stop loss, otherwise I don't think it's worth taking stabs as it's drifting into all-time highs. It's a balloon that you've got to let float away, and you'll just look for the next repeatable, actionable setup when it eventually presents itself. Next up, AMDizzle. What do we see out of the chart here? Sideways consolidation, midpoint of the range, nothing to do. It's got to give you this, or it's got to give you, at this point, this, underneath 158.80, or higher low clearly over 168.60. We're not there yet. Midpoint of the range, nothing to do. Metaverse. What do we see out of Zuckerberg's Fantasyland? This as a balanced range, look below and fail, broke out to the upside. This is a great looking trade here. There was no gap close, to be honest with you. I was thinking more so about the gap close for a better entry there, but as we walk forward, very straightforward. This, and that's going to have to become a saying, as we walk forward, very straightforward. I think I've said that twice or maybe even 3 times now. Again, it's late. It's like 10:17 Eastern time. What am I doing here? Higher lows there, looking really good. Looking for like continuation of this as a monster weekly bull flag trying to resolve in the upward direction. So I would continue to maintain the long stance out of Meta. If there ever was a time for a lower high, let's go to the daily chart, right? If there was ever a time for a lower high, I mean, you had a couple of instances. Number one, the resistance trend line in here after we sort of were, dancing around after this big break in the upward direction, the 50 SMA rejection, just nothing. Nothing on the sell side out of Metaverse, and we're starting to accept more so inside of this overhead range based on today's close. So maintaining that bullish stance. Next up, Tesla. This is very similar to AMD. Nothing to do inside of this balance range. Another failed breakdown today. So just like we had failed breaks in the upward direction here and upward direction here, we had a failed breakdown today. So look below and fail possibly. You could potentially, here's one for quick draw McGraw, right? If you're over 176, top end of the range at 180 is a possible target. But, again, if you just think back to the daily chart, you're sort of like picking up pennies here when the larger trades are really going to come from like, show me the acceleration, show me the movement under the daily 50, show me something under 173.50, or be patient and look for this, right? I personally did not heed my own advice over 180 on Monday, and it's got to be this. Like you can't afford to flirt with 180 anymore. It's got to be the higher low over 185.75 to get into that 198.85. Next up, Netflix. What's going on with Netflix? Daily head and shoulders is still in force. Watching for that right shoulder. It's really got to reject cleanly tomorrow if that's going to be in force off of 650.75. Let's go down to the hourly. There was the Stevie Wonder trade, which was great. That worked out just fine. But as we walk forward, I mean, you've got to call it for what it is. If this is an hourly double bottom, any higher lows over 644 jeopardize the daily head and shoulders that we were just describing as such. And instead, this is hourly bull flag now. And you've got to call it for what it is. Over 650.75, there's the possibility to move towards that head at 663.75. So those are the inflection points I would be thinking about. I would not be long here immediately on the Thursday open. I'd be thinking about pullbacks, building out a flag, and then looking for this. Or if the head and shoulders is going to stick, then fine. It's the same exact thing, but in the downward direction, you just want the lower high beneath 644. Next up, JP Morgan. And I've got 5 additional trade ideas for you. Can you imagine that at 10:20? 5 more ideas? Oh. This textbook Man Ray pattern, there you have it underneath the neckline, sort of towards the early stages of today's session. Bear flag breakdown, if you will, on the hourly. Under 198.75, again, this is not the place to chase new money shorts. The short was here underneath the neckline of your Man Ray pattern, or the bear flag breakdown. So the next setup is waiting patiently for some reaction off the bottom end of the range. The preferential outcome would be some sort of lower high that gets set here for a stronger short setup once again. Something like this in the downward direction. Rejections of 198.75. We can clearly establish that the hourly trend is down. Highs, lower highs, lower highs. Lows, lower lows, lower lows. That's your downward drift, right? So another lower high here sets up a short trade and you target the equal low. Beyond that, you're looking for an equal low flush. Let's go to the daily. This is where things get a little bit more interesting for a retest of this breakout point, right? And that would be down here at 194.25. Let me pull up these additional trade ideas on an additional screen, and here we go. The first one is going to be on PEP, Pepsi. What's going on with Pep? Pepsi is offering, oops, it looks like we did not even include the chart annotation, so we're seeing this in real time. Here's an hourly cup and handle. Your breakout point is over 174.25. You guys know the rules. Round numbers only up in the penthouse. And it's a thin structure retracement into the high of this bar. Ooh, we nailed it at 25 there. And then you have a possible gap to close into, let's go 90. 90 is close enough to a round number. We'll go yellow as we typically do, and yellow here as well. And then we'll back it off to a daily so you can see that setup as well. So hourly cup and handle, as well as a daily 3-bar play. Inside hammer, break and recapture of the 50 SMA. First target here, 176.25. Then the gap close is your next target. Would love to see that unfold into the end of this week. And that would also imply some sort of strength out of the XLP, consumer staples. We'll see if that follow through can, sort of lend itself to the rotation we were discussing just a few moments ago. So that's Pepsi. Next up is KDP, Keurig Dr. Pepper. And this, similar sector. Look at the breakout. Similar setup with a 3-bar play. As long as we're over 34.40, I would be thinking about consolidation and continuation in the upward direction. The options chain here is abysmal. If you are going to take this trade, I can't really recommend what you do. I can't suggest that you do something versus something else, but let me phrase it this way. If I were to actually follow up and action on this trade idea, I would probably just go outright with the shares and not bother with the options on something like KDP. Next up, let's look for a target as well while we're at it, right? We may as well just stretch this entire thing out and talk about everything we need to talk about today. That's going to be at 35.45 as a gap close, and then your high up here is at 36. We'll call 36 is a stretch, right? We're talking about something trading at the 35 price point. Let's round down there to 90. 35.90 would be the next upside target. And also from a balance range perspective, right? There's your range double. So 35.45 makes a lot of sense to me as a possible target, resolving this higher out of KDP. Next up, we've got ourselves ABNB. ABNB, there we go, if we could spell. And we do have this chart marked up, and this is a possible watch. I don't love the daily bar. It's technically a bearish engulfing bar. However, I think we can all agree if this wants to stay above some sort of right shoulder zone, maybe it's 145, it remains in force and it's attractive because it has a large gap to close overhead. 149.50 would be your breakout point, and your target would be up here closer to, we can round this one off because it's over the $150 price point. Let's go 156, right? That would be your possible upside target, daily 50 SMA. It's not in force. Again, the daily bar does not look great, but if the right shoulder can continue to build out, it's something to keep on your watch list. That's Airbnb. Next up is CRM for Salesforce. These guys just got wrecked on earnings, but trying to make a recovery effort, and I do like the high and tight consolidation. Look at the inside bars sort of forming here, not inside of the green large body, but the red inverted hammer is inside of the green indecision, as is the green hammer candle here. Generally speaking, this gap overhead is the target for what we're looking for to close, and it's in play as long as we're over 231.25. Here it is on the hourly time frame chart. We can all agree that this belongs in a textbook as a bull flag or whatever. Any higher lows in here, and you have an actionable setup, right? Your risk looks something like this. I mean, in a picture perfect world, you go to the target and close the gap all the way. Obviously, that's a stretch. That's not going to happen in one day's worth of trade, but generally speaking, if you're trying to traverse from A to B up here, I think you have reasonable structure to base some trades off. That was number 4. Last but certainly not least is everybody's least favorite drink or coffee shop, Starbucks. I'm going to get some flack in the comments for that one, as well as Lululemon the other day. So let's go to the daily chart first. Daily chart is completely in a budding uptrend, right? We have these higher lows, highs, equal highs, higher highs, higher highs. A little bit of a pullback from the 50 SMA. It seems scary at first glance, but if you notice, we've just pulled directly back into the prior high. I love the stair-stepping nature of this. You saw the pullback here. Where did it go? Directly into the prior highs. Let's see if the same thing can take place. So consolidation over 81. Eventually the break is back up over the equal high, or if you can grab the pullback, that's great as well. And your target is the full gap close. Right? Do keep in mind that the weekly trend is certainly down here. It's not like we have rainbows and butterflies. Oh my goodness, this is like picture perfect setup. But I do like the structure that's trying to emerge. One of the comments we made the other day when we were reviewing the IWM monthly chart was that all uptrends have to start somewhere. Right? All uptrends have to start somewhere. You can't just like flip a switch and say, okay, we've gone from this to, oh, gap up over the all-time highs, uptrend. I'm getting crazy now. It's 10:30. It's time for me to go to bed. That's all I've got for you in today's episode of the Midweek Market Update. If you want some hindsight trading, let's take a look quickly at ADBE for Adobe. You can see the tweet posted on your screen currently. Just a beautiful setup. So you should follow us over on X. If you're not following us on X, the Twitter X handle, whatever you want to call it, is at Trade Brigade Co. We had talked about this on Tuesday after the close, building this pressure cooker top into the equal highs, and there was the breakout from today's session. So if you want more ideas sporadically, if you want more charts shared with you, give us a follow. That is truly going to do it. I am off to bed. I'm hoping for some sweet dreams of profits, and we can make it a reality on tomorrow morning's session as the markets open up at 9:30. We'll be live at 8 o'clock for the pre-market prep. I hope to see you there with everybody else in the Penthouse Suites. Remember, coffee and donuts on Friday. With that said, have a green trading week, and I will see you in the next one.